Hi, and welcome to our LinkedIn Live series on the release of the ISM Report on Business. My name is Dan Zeiger. I'm a senior writer and copy editor for Inside Supply Management at Institute for Supply Management's member publication, and we're excited to have you with us today. The release of the Manufacturing PMI for June revealed a reading of 48.5%. That's a third straight month of contraction and the 19th in the last 20. The manufacturing sector, you could say, is in a bit of a rut right now. And we talk about location and direction a lot with the PMI. And the location isn't ideal, but it's also not the worst thing in the world, as we'll discuss. And stability is not something to take for granted. So we got a lot to talk about today, and I'm pleased to be joined by someone I always learn a lot from. His name is Timothy R. Fiore. He's the chair of the ISM Manufacturing Business Survey Committee, who will help us all figure it out. Tim, I know there's a lot to talk about, and one of the interviews that I heard you discuss earlier today, you concentrated a lot on some of the industries that factor into the PMI calculation, and some of the bigger ones, the capital investment intensive ones, and obviously the wait for interest rates there is going to be a big thing. So we can talk about all that. But just in general, just break down what the data said to you most loudly this month.
Okay. All right. So hello, Dan. Welcome, everyone. Thanks for joining us to this live discussion about what's happening in the U.S. manufacturing economy, which generally is 6 to 9 months out ahead of the U.S. general economy. For a good feel on the U.S. general economy, you're going to want to listen to Stephen Miller's review with Dan on LinkedIn Live 2 days from now. It's the services side is a really good reflection of what's happening today in the U.S. economy. So with that overview, I'm just going to summarize here. And in the month of May, I use the S's and Sam word quite often: stable, stuck, stagnant. And I think we got more of the same here, at least at the headline level. Now, there are, as usual and as normal, there are some movements in the sub-indexes that are concerning a little bit. I'm not sure concerning is the right word. They're not moving enough to really be that concerned, but there is some motion underway that we've got to keep an eye on. So first off, on the positive side of the report, we had demand seeming to maybe come back, or at least stop its heavy decline. There was indications that, early in the year, January, February, demand started to show signs of coming back very weakly. And then I think in April, May, we kind of put that in the back pocket and said, don't really see it. Same thing on the Federal Reserve. In the month of June, it looks like it's starting to come back. We had a PMI number that was okay, not great. It came into 49.3. It's okay. It's not expanding, but we're really not contracting. It's pretty much stable month to month. All right, that's good. We had customer inventories dropping down to the low side of just right, or the high side of too low, which I think is good, because the prior month, the month of May, we were either just right or the high side of just right. So it moved in the right direction. The other two, new export orders, don't see that moving for quite some time. I mean, China and Europe are still, nowhere near as good as we are in terms of economy. We're arguing about growth rates. They're talking about contraction rate. So we're in different ball fields with them. And then the last one is backlog, and backlog is not going to come back until the new order level far exceeds the production level, resulting in backlog at the end of the month. And that's going to take some time. But I would like to see it stop contracting so much. I mean, we're now close to 40 on backlog, 21 months of contracting backlog, and we're not contracting at 47, 48. We're at 41. So, and I think this is the environment that we've now set up for the not so good news. But before I get to that, the not so good news is really production/revenue. We're going to spend some time on that. Yeah. The other good news here is really the pricing number at 52. So just as a refresher, we did an updated forecast 2.0 back in May, and we revised our 3+% price growth for the entire 2024 to 1% price growth. So we pretty much, I think we cut it maybe by 70% or some big number. On top of that, in May, we said that we'd already seen 1.6. So we're only going to see 0.3% additional price growth for the last 6 months of the year. Well, the 52 PMI index for prices is probably in that range.
Mhm.
So we're kind of validating our survey, which is what I like to do because I don't like to provide opinions without at least one supporting
Mhm.
backup fact meaning. So the pricing index coming down to 52 is good. It's the third month of declining price growth, which is good. It is very supportive of the PCE number that came out on Friday, which was really a PCE number for May. And we're now reporting price growth for June. So if you take the sequence for May, we reported it early. We said we were coming down 57, I think was the number from 60. Yeah, 50, 57 from 61 in May. Now we're in June. If that same profile follows, you could easily see that the PCE is going to be somewhere less than 0.1% in the month of July, which, remember, the Fed is looking for facts and a long enough series of consistent facts to make a move. They want to make a move, but they can't make a move when the facts are jumping up and down, the lumpy thing that we've seen, the better part of this year. But this supports the Fed making a move. The question is, will they make a move before October? Because they're not going to make a move in October. So it's really August, September. They got to do something soon. You can see the whole election thing is heating up. It's getting really ugly. Who knows where that's going? That's putting a lot of uncertainty into the business. 11% of our headline comments were around interest rates, and that's up from 6% in the month of May. So more and more of our panelists are saying our customers are refusing to move because of interest rates. All right, so we're still stuck. So the good news was prices are coming down. Good news is that our new order rates are showing some signs of life. And the other good news is if you took the seasonal factors out of the three of the four that we adjust, ignore the inventory number. That's a separate issue. If we took the seasonal factors out of new orders, production, and employment, all three of those numbers would be 50 or better. So that just supports the fact that we're still in the same environment that we were in last month. So, which means we're stable. Let's take the better word. Stuck is a negative word. Stable is a positive word. So we're stable. There's nothing wrong with that. And that's where we're at.
You talked about interest rates, and I'm sure a lot of viewers kind of, okay, well, what does that mean exactly in a tangible effect on how a business is going to operate? And I know you spoke in a call earlier today. You mentioned some, two industries in particular, machinery and fabricated metal products. Those are kind of really capital intensive industries, and just discuss how they operate. When you have this kind of environment around interest rate uncertainty, or at least waiting for hopefully September, which is when most people think the Fed will make and do anything if they do anything.
Yeah. So, our forecast, when we started the year, we thought we'd spend at least 12% beyond 2023 in additional CapEx. When we updated that came down to, I think, less than 1%. So essentially, we're not going to expand our CapEx more than what we spent last year. The good thing is it's not negative. It could be negative. So when interest rates are up, companies have to refinance their operation. They do it through bonds. They do it through lines of credit. When the Fed funds rate is up, all of those cost more. So the whole goal here has been to raise interest rates and then drop interest rates before a majority of your businesses need to refinance their bonds, because nobody wants to go from a 4% bond to an 8% bond. So the longer these interest rates stay high, the less likely they're going to be able to refinance those bonds at something that's affordable to them. And so if this goes on for another year at high interest rates, I'm just going to throw a number out here, 50-something% of companies are going to have to refinance bonds at a lot higher interest rate, which means it's going to whack their profitability. That's a headwind that goes right to expense, interest expense. It's like, oh God, I'm paying more for the money I need to borrow. There's not a lot of value add there unless you're a bank. So it's not good. In the meantime, what they're trying to do is limit their need to borrow more. So the way they do that is spend less capital, less money on capital, because that's a cash outflow, capital expense, and spend less on working capital, which is inventory, accounts receivable, and accounts payable. We're seeing the impact here of inventory a meager, a frugal perspective on inventory. They're running as lean as they can run. They're not taking any inventory that they can't convert quickly. And you're seeing that in the number here in June still. Usually as we close a quarter, sometimes that inventory number drops in that last month of the quarter. Sometimes it comes through the following month. This month, I think is coming through in that last month because people are very confident that they've dropped their working capital, i.e. manufacturing inventory account in June, even before the month ended. Inventory is a tough thing to measure for a buyer because you don't really get a number until the books close 5 days later.
Right.
So it's hard for that. And you have a flow in and out, in and out. It's a difficult thing to understand. Not a lot of the companies measure this stuff daily or even weekly. So, but when you're holding back inputs and your output is meeting expectations, then probably your manufacturing inventory is dropping.
Yeah.
The other thing here is that nobody is investing in making inventory. So our panelist companies are not building finished goods inventory or even semi-finished goods inventory in the hopes to be able to improve customer sat when they call up with an under lead time order. That's not happening. So, and the reason it's not happening is nobody wants to pay extra for that investment. And until we see some relaxation on the rate side, you're not going to see general managers decide to go ahead, okay, build some inventory, I'm okay. It may take me a couple of months to bleed it off, but I feel confident that 2-3 months from now, I'm going to be able to bleed it off. Go ahead and build it. Because, remember, as people start to destaff and because the bad news here, let's get to the bad news, is that the production revenue line, production, which is a surrogate for revenue, especially if you're not building inventory, is now declining. It's declined twice in the last 6 months. This one worries me because, as I said back in May and probably even in April, we're doing fine as long as that production number stays above 50 because our profitability is still good. It's giving us time here to destaff appropriately. Now that number is below 50, it's indicating that we're stepping back production because we've run out of new orders and backlog to work on.
Yeah.
So at some point, I'm not that concerned about 48.5 besides its signaling factor. If it remains where we are with lack of new orders coming in, then you're going to see that number probably drop to a 47. And that's going to precipitate a more aggressive approach towards layoffs and hiring. And right now we've kind of avoided that. We've been able to work through the last year and a half, slowly destaffing in anticipation of a reduced output demand. But now, Q1 was 1.3% GDP, third estimate. I don't see anything in Q2 that would indicate it's better than Q1. It feels kind of like the same. You can maybe even argue in the May timeframe, April, May, we actually step back maybe a little bit. So if we're operating at less than 1.5% GDP, we haven't operated that way since 2017, I think. So that's not good. If that's the going forward, and this is an election year, if that's the going forward, you're going to see more pressure on employment drops. And I would hate to see that. We work so hard to get to a soft landing, to maintain the good people we work so hard to hire. But the fact is that when there's nothing to work on, you have to make the decisions. You have to release people. We've been releasing people. We're probably releasing that 10 to 15% that just doesn't fit. They don't like the job. They don't understand, whatever. But then you start cutting into people who are actually productive. And that would be the next wave that we're looking at. And that would happen if that production number continues to sag another month or two. And that's bad news.
Yeah, I know that was a theme throughout a lot of 2023. The companies were trying the best that they could to hold on to the people that they had because they were anticipating that demand would pick up a little bit, and they just didn't want to let go of the people they worked so hard to bring on. Do you kind of see similarities to that same situation? Because as we know, eventually they had to let some of those people go. They had to right size. Any similarities from the current situation now as to what we're seeing then?
Well, let's just look at the last 6 months. We started this year very optimistic, without the benefit of any indication that we were at the top of the rate increase cycle. It was a tailwind for us. Rate cuts were a tailwind.
Yeah.
What happened 2 months ago is that the lack of rate cuts are now a headwind. because nobody's willing to extend themselves, commit because of the uncertainty. And, you know, you have an election uncertainty, you got, global unrest uncertainty. We got the potential for supply chain stuff coming back, although I don't really think that's a huge issue. The Red Sea probably has just added time and expense. It hasn't really disrupted the supply chain anywhere near what we saw in the pandemic. So, but uncertainty is a huge enemy of business investment, especially when you're looking at CapEx, which are generally long-term commitments that are not easily cancelable. And then you're stuck with higher depreciation in a period where you can't absorb it as well. So we started the year very optimistic. Our update 2.0 in May stepped it all back down to essentially saying we're going to run the rest of this year kind of like the same rate that we ran the first half of the year, and don't really see anything changing. We're concerned about interest rates. We're concerned about the election cycle. The positive thing is none of these candidates are talking about deficit reduction beyond just the terminology.
Right.
So deficit reduction would mean, significant cuts in expenses out of the federal government, which would probably drive us, much closer to a declining economic environment. Nobody's talking about that. So the big issues here are: we're going to invest in carbon energy, or we're going to invest in green energy. The carbon energy is an immediate benefit to the economy in all areas. The green energy is a longer term benefit to the economy in many areas. So that's the kind of choices I think that were set up here for the economy. But nobody's talking about deficit reduction.
Yeah.
So the rest of the year is going to be slow and sluggish. Another S word, two more S words. I think I don't see, even if the Fed steps in now and cuts a quarter point, that will improve confidence, I think. And we may see a slight move on the new order side. But that's not going to get us to 58 to 60. It'll probably get us to 54.
Yeah.
And maybe 3 to 4 months later, we'll see that backlog get back to 52, 53.
Yeah. Another question on inventories. I mean, it's something that's always, as we've talked about, it's something that I've always considered one of the more challenging supply chain disciplines. I don't know if I could do it, especially in an environment where you just don't know, when demand is going to pick up. And there was something in the report that I really took interest in. You had mentioned that, with companies willing to invest, that does kind of put a little bit more pressure on suppliers to have, stock on demand. Just, talk about that, facet of the game. Is there a sense that there's, suppliers are kind of feeling more pressure, and just how does that dynamic fit into the whole inventories picture?
Yeah, thanks for bringing that up. Yeah. So that's one of the early there's a couple of early indicators here that you can follow to see what direction we're headed in. One of them is transportation access. Can you get access to road freight as when you want it and at a price that you can afford? And we all remember what happened in the pandemic. It got really whacked out, crazy stuff. We're now 2 years into a declining transportation environment where rates are sluggish, even the spot rates. So until spot rates come back strongly, the transportation sector, as an early indicator, is indicating that nothing is happening. The other one is chemical products. We have 18 industry sectors in manufacturing. At least a couple of them, there are others, textile mills and things like that, but they're a much smaller impact. Chemical products and fabricated metal products are two feeding industry sectors that go into the other 16. The chemical products one probably impacts more of the other 16 than the fabricated metal products. Chemical products has shown it started to grow in the trough. Started this year, I think we broke 50, but we're still only sitting at 52 or 53. It's not taken off, but it is expanding slightly, marginally, which is okay. The fabricated metal products, though, is contracting strongly. Think 44. I think I mentioned that number this morning. It's machinery, fabricated metal products, and transportation equipment now are all near 45. And that's alarming. So transportation equipment is our number 2 industry sector. And we haven't seen this kind of bad performance through the pandemic. And even I don't even know that we saw this back in 2019 before the pandemic hit. So we're now at very low levels. That's aerospace, trucks, and cars. And the aerospace sector is struggling because of complexity and quality issues, and it's not because of demand. I think the auto side is probably now getting weaker. The truck side's absolutely weaker because of demand. So, okay, fabricated metal products goes into construction equipment and automotive sector. The construction being first, construction projects, not the yellow goods, projects, bridge beams, stuff like that, buildings. We had a lot of comments in May about the construction industry is off to a slow start. The question is, was it a slow start or is it going to be below expectations? The month of June is indicating it's going to be below expectations, which is another, that's a warning sign. That could be because financing construction projects outside of the federal government is quite a bit more expensive now than it was 3-4 years ago. And until you see signs of that expense dropping, i.e. interest rates being cut, you're probably going to see a bunch of holdbacks. We know we already have issues with commercial real estate. We still have offices that are not full. So this is really more around housing. And we know the situation with housing. We don't have enough inventory because people aren't willing to move because interest rates are too high. They know if they jump to a new place, they're going to have to refinance at maybe twice their current mortgage rate, which eliminates their ability to buy up. Yeah. So, these things have to the Fed has to make a move, I think. I don't know if I mentioned it yet. 11% of my headline comments said that the Fed needs to do something with interest rates. And our panelists they're supply management people. They're not finance people. They're not general managers. They're not bookkeepers. They are supply people. And what they're saying is that there needs to be some action on the interest rate side for our customers to feel comfortable enough to go ahead and start placing more orders with us, and for us to feel comfortable enough about making CapEx investments, not only for additional capacity, but also for replacement capital that, by now has got to be wearing out. So that's what we're all waiting for, Dan.
Yeah.
I think, if I think about this, outside of geopolitical issues, major disruptions that, seem to be being managed fairly well so far, tax on shipping in the Red Sea. The biggest variable right now is really the Fed interest rates.
Yeah. Well,
even more than the election. I mean, like I said, none of these guys are talking about deficit reduction. So the question is, where are they going to, push money to?
Right.
Whether it's the conventional energy side or whether it's the non-traditional energy side. That to me seems to be or, you never know on the Democrat side, like they did this time around, they put a whole bunch of money out there into the market that really fueled a heavy expansion in the manufacturing sector. And as we said back in when Biden got elected, 2021, it probably wasn't necessary. And, we kind of felt that it fueled inflation. But it was, it was what, $2 trillion that was sent out a couple of months after the inauguration. I don't think that's going to happen this time. That would not be responsible. And I don't think it's going to happen, but you never know. I mean, politics are politics. You just never know.
Yeah. I mean, we've talked about the contraction period. I guess we're coming to the bottom of the hour here. Let's end on a, big picture philosophical question. If you map this out on this contraction, I'm sure I got my spreadsheet numbers right, the low point is 46.4 for the PMI. The high point is 50.3. I've joked with you and Christina sometimes. You look at some index numbers, the volatility. I joke that the graph, it looks like an EKG sometimes over a period of months. But this, by comparison, is just, it's almost a straight line. I mean, has it, been kind of surprising for you to look over, the history of this contraction period and see that, how does it compare to past contractions, or, and as you look forward, is it kind of comforting, that it's not going to fall off a cliff, as you like to say, as you look over the period of this, the contraction period and looking forward, just kind of philosophize about it, I guess.
Yeah, well, I think it's a direct result of a soft landing, a touch and go. I mean, and there's a lot of good things that have come out of that. There's a lot of not so good things. I don't know that we successfully had a soft landing, at least in the last 20 years, but we're trying to pull one off here now. And you're right. I mean, the PMI in the last couple of years has been operating in a very narrow band, which is not normal for the PMI, but it's okay because all it's really saying is that we've been very stable. we've been slowly coming down or slowly going up, with depending on the perspective. There's no dramatic things happening in manufacturing, and usually there is. So it just supports the fact that we are in a soft landing. The question is whether we'll be able to do it effectively or not. So, because the flip side of that is, if you did want to see those sawtooth spikes, a hard landing would have given it to us. We would have saw, a collapse in employment. We would have saw a collapse in production output. We would have saw a collapse in inventory accounts. You would have saw a ton of stuff. Prices index would have hit 35. Kind of like what we saw I almost look at what happened in the pandemic. I mean, it probably wouldn't have been that severe. We can go back to the recession. You can look at the numbers, but you would see all the indexes collapse. And then the good thing about that is you kind of know you're at the bottom, and therefore you're going to start to climb out. We never really got that collapse, so we're kind of searching for indicators that would indicate that we're either at the bottom or climbing out. It's been difficult for me. Fortunately, I have access to a whole bunch of comments from the panelists. And I've got a quick look, and I talk to a lot of people, and it gives me the confidence to say, hey, here's where we're at. I'm fortunate that when I make a statement, I like to have one or two or three things backing up that statement. And I've been, in most cases, I've been pretty good having that. So, I think this is the problem with a soft landing, that you're not exactly sure where you are, except you're where you were before. So, all right, but how are we going to get out of this? It's not going to be natural demand coming back, because we entered this with lower interest rates. We're now sitting in the middle of it with higher interest rates. You got to argue that the only way we're going to start to get out of this back to a normal rate is we got to get back to 4%. I think the Fed has telegraphed that probably a normal rate is 3.5 to 4%, 4.2. That feels about right. It gives them some ability to cut rates, gives them ability to raise rates. We sat at near zero rates for 10, 12 years. So, okay, let's get on with it. But, they need facts to support their decisions. This month's report supports their facts that things are slowing down. Don't let them slow down too much. Last month, we provided the same kind of perspective. Things are slowing down. Don't let them slow down too much. Yeah. That's how we were going into July, is that we're still slowing down. Don't let them slow down too much. Now that we have revenue coming off, that may drive other actions with our panelist companies, and it won't take long because they've been waiting. They're not investing in CapEx. They're not investing in working capital. So they're waiting for, if nothing continues and they don't have backlog to work on, new orders aren't showing up, there's going to be more employment actions. And then everything starts to change. So yeah. I'm hoping in the next couple of months that the Fed makes some kind of a quarter point isn't going to really change the economics, but it is going to signal that we are now in a rate reduction mode, not a rate increase mode.
Yeah. Well, that's a great synopsis of, the value of the report on business and how it fits in not only to how companies approach it, but also, federal monetary policy. That's a great way to end it, Tim. Thanks a lot. And thanks to you for joining us today. For more information, feel free to go to ismworld.org, where in a little bit you can read our roundup article that details a lot of what Tim and I have discussed here, as well as the reaction of the markets. And join us on Wednesday when we discuss the PMI with Steve Miller, the Services PMI with Steve Miller, who is the new chair of ISM Services Business Survey Committee. And if you'd like to be a part of the ISM Manufacturing Services or Hospital Business Surveys committees that help compile data for the report on business, visit ISM World /join the panel for more information. And so for Tim Fiore and some good folks who helped us behind the scenes today, Christina Cahill and Jennifer Stevens, my name is Dan Zeiger. We'll see you next time.